Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode explores a new topic with a guest who brings their unique experience and knowledge. Tune in and discover something new each time you listen.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today we have a guest, Scott Hildenbrand, on with us. Scott's been on the podcast several times before, and usually we reach out to Scott when it comes to deposit topics and just sort of what's going on in the deposit space. And I thought it might be appropriate to get Scott back on the podcast to just talk about, the latest interest rate moves and some things that are going on in the M&A space and see how it ties into his world. So without further ado, let's get to Scott. So Scott, thanks again for joining me on Bank Talk. You're a regular guest. I'd probably call you the most regular guest we've had. So thanks again for joining us and spending a little time with us.
I always look forward to your invites and always concerned I may not get another one if I say something the wrong way, right? But no, kidding. It's great to catch up with you, and our paths sometimes align, and it's great to kind of catch up on the markets and what's going on from both of our perspectives. So it'll be fun today.
So Scott, I always like to hear about your side of the industry because first of all, you got a great background and you're always providing guidance to your clients. But let's talk about, what does this time of year look like for you? Is there something special going on this time of year, or how do you wrap the last couple of months of your year up in your space?
Yeah. So, well, as you can imagine, with the government shutdown in there for a little while, you can imagine how many airports I sat in for a long period of time. So, Charlie, I've had a lot to talk about and think about. It's scary when you can't move anywhere and you're sitting in an airport, you have no control. But I would tell you kind of this October, November has always been notorious for a couple of things. One being, okay, we're now into the fourth quarter, right? We have a really good feel. If we're a depository right now, we have a really good feel kind of where we're going to end the year, right? And so what that does is it kind of allows CFOs and boards and management teams to kind of think a little bit about next year and the next coming couple of years, while in conjunction with budget season and strategic planning season. So typically, what'll end up happening is I get a phone call after the first or second draft of a budget. Nobody's thrilled with it next year. And so what can we do now to establish ourselves and give ourselves a little bit of boost for next year? So one of the things we'll get a fair amount of questions around is, should we reposition our balance sheet now? You've had a couple of rate cuts. You've got some volatility in the market. Is there something to do there? Is there something to do from both the growth or shrinking perspective of the balance sheet, interest rate risk, liquidity, the capital markets, the M&A market? I mean, there's so much that's all connected, but the core of everything is, how does your balance sheet look and how can it handle all the different movements and variables? And so we're spending a lot of time there thinking through what can be done. And I'd say, if there was anything I could pinpoint, a lot of folks still thinking about assets they purchased or originated probably 4 or 5 years ago that are still on the balance sheet and going to be there a while, right? And are we supposed to jettison those? We still have those conversations. It is always a long debate in boardrooms about what to do, when, and how. But I'd say that's probably my number one sort of ask or requirement is, hey, Scott, come to our board and help us get into a healthy argument about whether we should take a loss now and improve next year. And let's work through that. And so I'd say that's number one. We just had our equity investor conference down in Miami last week, and we probably had over 150, 160 publicly traded banks. And so they come down, we bring all the investors in community and regional bank stocks down to have one-on-one meetings. I sat on a panel with Bill Burgess, who runs investment banking for us, and myself, and kind of chatted through what's going on. But you learn a lot down there as well. And so I think also people are a little frustrated on the public market side. I think earnings have been really solid in the third quarter. Credit has held in for the most part, and we could probably touch on that later. But I think there's almost a little bit of a disappointment in great earnings or really solid earnings, and yet the valuations of some of these publicly traded companies aren't following the historic norms. And so I think that can be a little frustrating for some management teams at times as well. And so we'll dig into that, as well as kind of thinking through budget and strategic planning session. So hopefully I answered that question okay for you.
Oh yeah, excellent. And when you think about it from a publicly traded operation, are they the concept that their price to earnings are kind of too low, or what they think their market value is versus where it should be? The frustration is in that scenario, or is there a different, did I misunderstand that?
There's a dynamic that's going on that I think, a lot of people talk about. So this is not going to be earth shattering for your listeners, but it is something that for a while, I don't know if I bought in as much as I buy into it now because I'm seeing it more and more. And that is, unfortunately, scale really matters in today's world. And so with the larger institutions, they're probably a little closer to trading at their historic norms on an earnings multiple than I would say some of the folks who are smaller in size still publicly traded. And I think there's becoming a larger, unfortunately, disconnect between valuations of folks that have enough scale to continue to invest in technology, talent, and infrastructure, and some of the smaller folks who are trying to figure it out and doing a great job of it. But investors see things, through slightly different lens than just your normal math returns and how you're doing. And so I think there's definitely some community and regional banks that feel like, wow, I keep putting up good numbers and my valuations are not really improving. And one of the things I hear sometimes is that it's hard to get, Charlie, it's hard to get what we'll call generalists to invest in the bank stock world. And what I mean by that is the typical folks that have bought in bank stocks over the years are playing in the bank stocks that they want to be in. I'd say that the generalist market that choose between every type of industry are sort of looking at the bank industry. It's still in a little bit of a negative tone, both around sort of how much returns can really be there, what kind of growth is there, and there just hasn't been as much excitement from a generalist perspective. So I think that's hurting a little bit of the valuations as well.
Gotcha. Yeah, and I suppose between that and the conversation around is the timing right for us to either take a loss or, play in the balance sheet a little bit to make it better for next year. I suppose that all adds into the sort of the complexity of trying to make a decision or a
That's
strategic
right.
decision.
That's right.
Yeah,
Yep.
gotcha. Okay. Well, hey, I had a couple of specific questions I want to cover during the podcast. The first thing I want to kind of talk about a little bit is just rate cuts. Does this, I think everything I've heard, the rate cuts were anticipated. I don't know if it was the higher number or lower number, but I don't think the rate cuts were a surprise. What does it mean to the depository institutions these days, or how's the feeling after those cuts?
Yeah, I would say you're accurate. I would say so far the rate cuts, nothing has been a wow or a shock to the market. So I think that's always helpful. But what's interesting, Charlie, to me is a little bit less about the rate cuts and a little bit more about, well, what's next? And that's where the rest of the yield curve is impacted. You and I have had these conversations, and I promise not to nerd out too much, but what I care a lot about is what the shape of this yield curve is going to look like. And so, given any day or week or month, you can see a lot of volatility in the expectations of how many rate cuts, how low will we get. We've still got an enormous amount of debt outstanding. You've heard the administration be very clear that they want lower rates. And so you're kind of in this interesting dynamic. And so I think asset liability managers are in the spotlight right now. And it's not about what to do, it's about when to do something, creating triggers to say to the rest of your outgoing management team, hey, if and when the yield curve looks like this, we're going to have this issue. So these are the types of things we can start putting in place to address those concerns. And I think that's where a lot of people are spending time right now, quantifying cost of protection to different multiple rate paths in terms of how many rate cuts, but more importantly, what is the shape of the yield curve going to look like? Because that really impacts your existing balance sheet and then obviously where the growth is going to come on from a spread and volume perspective. So there's a lot of noise around balance sheet management and rate cuts. And then you got the traditional thinking of, okay, rate cuts in theory, and it should play out, hopefully, should lead to lower deposit rates. I think what we're faced with in the industry right now is that loan growth is actually pretty solid. It's not perfect and it's sporadic in markets, so don't get me wrong, but loan growth is pretty solid right now. I think there was some pent up borrowers waiting for some kind of crack in rates, and they finally saw a little bit, so they feel like, let's go. I think the more interesting one, and one that you and I often talk about because I obsess over it, is where we're going to be in the deposit front. Are we going to be able to lower rates in lockstep or in some conjunction with the Fed? And I'm not convinced, and people get mad at me sometimes. I'm not convinced we're able to pass through as much of these rate cuts as we used to, with some of the larger institutions being out in the market trying to grow scale. That puts a challenge on how much you can actually lower rates, especially when loan demand is strong and the rest of your asset base, that your securities portfolio is sitting there at 2%, sitting out there for another 5 or 6 years and not really providing enough liquidity for you. So that's a challenge, I think, that bank management teams and depository management teams in general are facing today.
Okay. Yeah, and I think, as usual, right? Sometimes you move a little too fast for my slow mind. So let me ask you a clarifying question, because I'm not sure. When you said depository rates and sort of the cost of the depository rate in that sentence, are you saying if they don't have sort of demand deposits that they're paying nothing for, and they have to go out and get CDs, they've got to go out and hit their Fed line or whatever? But how are the bankers thinking about cost of deposit?
That's what we're saying. We're thinking, like, if the Fed is lowering the short-term interest rate, typically folks will try to price in that same direction that the Fed's moving. And so if the bank world is all about the deposit base, what type of deposits and how quickly they reprice. Right now, we want them to reprice quickly if the short end is
Sure.
down. However, it's always going to be, Charlie, a supply demand game, meaning if there's solid loan growth and deposit growth hasn't quite matched that, you're not going to be so quick to lower a bucket of your deposit rates, because you and me and others may say, well, wait a minute, if you're lowering my rates, I may leave and go find someone else to pay me a little bit more. And those options are all out there. And so that's what I mean by, historically, how much can I lower my deposit rates as the Fed cuts interest rates? Historically, we've been able to do a pretty good job of that. I think it may be a little slower this time around, as people think about balancing growth versus spread of what they're earning off of those deposits.
We'll be right back.
Ever feel like your tech budget's running the show instead of supporting it? You're not alone. Between bloated vendor contracts and outdated systems, a lot of banks are stuck paying more for less. And here's the kicker. Those big tech vendors, their contracts are built to protect them, not you. So if you're hesitating to make bold moves because of tech costs, it's time to flip the script. That's where Remedy Consulting comes in. We help banks take back control, cutting through the fine print, optimizing spend, and finding tech solutions that actually fuel growth. And we're offering a free review of your tech stack, spending, and vendor contracts. No pressure, no sales pitch, just expert insight to help you make smarter decisions. Even if we're not the right fit, you'll walk away with clarity and confidence. So go to remedyconsult.net or call 206-295-5776. Let's make your tech work for you, not against you. Thanks for listening to the BankTalk podcast.
Gotcha. Okay, no, that's great. That does clarify it quite a bit for me. Okay, so I know we brushed on this a little bit earlier, and again, just in my "what have you been up to" conversation, but for 2026, right? Like, what are banks thinking about? You kind of talked about strategic planning. You talked about, getting prep for budgetary purposes. Talk to me a little bit more about the conversations and what people should be thinking about in your space related to 26.
I kind of think of it in sort of three ways. I think about it in my core balance sheet, my organic balance sheet of where it is today and headed into 2026. Are there any things that I can do strategically to kind of sort of trim the hedges around any exposure I may have to higher rates, lower rates, flatter yield curve, or a steeper yield curve? So that's kind of the first litmus test. Make sure the core balance sheet's good. Then you start thinking about where the growth is coming, and the growth can come in two ways, right? The growth can come organically from your lenders and deposit gatherers, which is great. That's what we're in business for. We're out there looking for more great relationships to bring on to the balance sheet. I think the other part of this is, and where the game is really picked up, is there's organic growth and then there's acquisition growth. And both of those strategies can play together, right? I don't think you turn your face to one without the other. So I think management teams are thinking about the organic balance sheet. They're thinking about organic growth and what that looks like in markets. And do I hire some teams? And do I have the right technology and people in place to grow this? And then it becomes, from an acquisition perspective, all the banks I work with, they've got a target list of folks that they would love to not necessarily acquire, but at least inquire about potentially partnering up. And what you have seen in 2025 is, if you think about 2023, we had the SVB mess, we had interest rates really high, the merger market was really slow. 2024, it started to pick up a little bit. 2025, I would say, if you're going to look at the administration changes from a regulatory perspective, my view is the biggest change has been how quickly deals can get from announcement to close. That's important. That time period has shrunk dramatically over the last 12 months, which is a great thing for the acquisition market. And the other thing that, Charlie, that's really interesting is now, for the first time in a while, banks can announce more than one deal, right? You saw Huntington come out and purchase Veritex, close that deal in 90 days, and immediately announce another deal of purchasing Cadence. So two banks headquartered and have markets in the Texas area. To do two deals like that was sort of unheard of for a while, certainly in the past administrations. And so what you're hearing from our client base is, not only do I have to have a list of banks that I may want to acquire, I now don't have to wait on the sidelines and only buy my prime A target. If there's a B or C number on my list of people I would actually also like to acquire, I can still go do that deal and not necessarily give up the opportunity in case the A, my top choice, comes up for sale. So that's been really interesting to see that dynamic. Those two changes in the M&A market are leading to bigger deals and more deals getting announced in 25 than in 24 and 23, I think combined maybe. And so you're seeing the velocity of M&A continuing to increase, not wildly crazy, but every sort of month, 60 days, you're seeing a few more announcements than you did the previous 60 days. So something to keep your eye on.
So when you talk about the concept of being able to sort of do two at the same time, do you think that the biggest tailwind there is the regulatory got removed? Or is there a different for that scenario? I know you said regulatory probably headed up the faster, sort of announced to close period. Do you think that's the same reason that you could do a 2-for-1, have multiple targets in your list at the same time? Is that regulatory, or is there some other thing driving that?
No, I think it's very regulatory driven, because some of these buyers who are now announcing multiple deals without the regulatory regime change, I don't believe would have been able to do it. So to me, it really does show that this is regulatory driven, and it is business friendly. It is acquisition friendly. And certainly it is played out. I gotta believe it's almost all from the regulatory side of the world. Not that the mergers are picking up, that's not it, but it's how quickly they can close, and the fact that I can do more than one deal in a similar time frame is sort of game changing, and that's really regulatory driven.
Gotcha. So it's just an easier climate to do business in.
That's right.
More or less.
That's right.
Yeah. Are there any other criteria related to the M&A stuff? Right? Is what beyond regulatory is kind of a tailwind versus a headwind?
Sure. I think the second part of it is succession planning, and one of the higher correlations between a bank that's been sold is typically you look at the age of the CEO. He or she doesn't have a great succession plan in place. A lot of times when that's the case, there will be an acquisition to address that. And so I think succession planning, I think the frustration around, you went from zero rates at COVID and a big challenge there to the SVB signature failures, higher rates, It's been a really tough 5-year period of time to operate banks. Now that the regulatory regime is friendly and I'm concerned about succession planning, I've probably got a couple of years to think about if I'm a seller of getting my ducks in a row and thinking about who I'd want to partner and sort of with and operate with. And so I think it's succession planning. I think it's a little bit of pent up frustration and certainly the regulatory regime making it easier. So there's probably some other things as well. Market share and scale, as I talked a little bit about, will always play a role in the merger market as well. Because at the end of the day, you find another great franchise to bolster onto your franchise. You get some cost saves, right? As you know, and the cost saves and hopefully can take some of that and invest it in technology. And there's going to be a lot of talent in the next 5 to 10 years in the bank industry moving places because of these acquisitions. So strategic planning session right now is really important, whether it's organic growth or it's acquisition growth. I think either way, people are arming themselves to go at least either look for another bank to buy or look for talent or both.
Yeah,
Because,
that's a great
right?
perspective. I hadn't really thought about the talent side of it quite as
Oh,
much
yeah.
because
Yep.
because people are getting displaced and they're not. Sometimes it's political, right? Sometimes you got two COOs and the COO, who's the best friends of whoever's going to be the CEO, is going to get the job regardless of the person being displaced. So that happens. That, I mean, I think we've all seen that in the market, but just the fact that now you have a talent pool at the C level that's available and capable, right? That
Yeah.
helps if the goal is to keep the bank in the family, or find a place for the CEO to go retire and not worry about whether the place is in good hands.
No, having gone through an acquisition myself, being acquired 5 years ago or so, you wake up one day and you're doing the same thing, but it's not the same company. And so you have to it almost allows talented people to say, well, I was really happy here. This is a mark to market, so to speak. Am I still happy? Or maybe I'll take a call or two
Yeah.
from someone else. And it kind of gives that moment of reflection of maybe I do want to stay here and it's going to be great. Or maybe I should listen to some of those offers that I hadn't thought about. And so I think there are people thinking through both the whole acquisition or just some displaced talent, as you outlined, Charlie. Both of those matter and will play a role here in the next 5 years or so.
Yeah, that's really interesting. I mean, given the fact that a couple of years ago we were talking about, I think it's still probably, if I were to walk around with CEOs, I would say they probably would still say entry level talent's still hard to come by, right? Like entry level, even though you're not losing your tellers, you're not losing your new accounts folks for the most part, I'm guessing, in a way that the guy next door could grab them from you. So my guess is most of the conversation is probably around the C-suite because if the level is low enough, they just go work in a different industry, right? But
And
okay, yeah, interesting.
and also, Charlie, I think you're bringing up a point that sometimes people don't want to hear, but at the top of the house and at the development house part of the house, the younger folks coming in, you think about polling, right? College seniors right now and saying, do you want to get into tech? Do you want to get into AI? Do you want to get into energy? Do you want to get into consumers or do you want to get into community banking? Right. It's hard. And so I think you're going to feel that over the next 20 years. We've been feeling it. That's a slow bleed, but that's a challenge. And so I really applaud the folks who go out and talk about the opportunities in the community bank world. There's 4,000 banks in the country. There needs to be new leaders being developed, right? And so there's going to be huge opportunity here, and with a shrinking pool of individuals that probably want to be in that space. And so I'll probably get some hate letters saying, "Hey, community bank is great. I love it." I'm just saying it's hard to get 21-year-olds to really kind of say, "Oh, I'd love to be an asset liability
Yeah,
modeler
get
like I
excited,
was at
right?
21." Yeah. Yeah, that's right. That's
Yeah,
right. I loved it, but someone wants to do something else, and so there's just some more trendy industries to potentially go into.
yeah. No, that's a great perspective. Okay, sort of one last item I wanted to hit on, and knowing us, this might not be our last one, so I'll just I'll caveat it at that. But talk to me about the capital markets these days, right? How
Yep.
are folks raising capital? Just what's going on in that part of your world?
When I think of capital markets, Charlie, I think of sort of three buckets. I think of the debt market, right? Because debt can be raised. I remember you and I having this conversation years ago. Debt can be raised through the public private markets, through institutions, and it can count as regulatory capital, right? And so you've got the debt capital markets, which I'll touch on in a second. You've got the equity capital markets, which is kind of the traditional common equity raised to bolster and allow yourself to grow through the capital raise. And then you got what I'll call the in between, which is the preferred market. So I would say the debt market first. The debt market is wide open, completely on fire, and it makes all the sense in the world because a lot of the sub debt that was issued by the community banks throughout this country was issued in about 2020, 2021, and 2022. Why is that important? It's important because most, not all, but I'd say probably north of 90% of all the sub debt that was issued in 2021 and 22 was structured in a way that it had a 10-year maturity. So the banks would go out and raise debt for 10 years. And the rate that they were going to pay investors to invest in that was fixed for 5 years. Well, we all remember where rates were in 2021 and 22. They're very low. So people came out into the market, raised debt at, 4% on a, somewhere in that range. And that was able to be counted as regulatory capital. The interesting part is I'm not that bright, but 2020 was about 5 years ago. We're coming up on the 5-year period where that debt starts to reset to a floating rate.
Yeah. So you're
Now,
at the balloon period, more or less.
there you go.
Gotcha.
There you go.
Interesting.
And you have a decision to make. Do I let this debt float on SOFR plus some spread, which would be higher, much higher than what they're paying today? And also the second part of this, and again, not to get granular, but it's important for your listeners, after 5 years, you start to lose benefit of how much of that debt counts as regulatory capital. 100% of it counts as regulatory capital the first 5 years. After that, you start to lose how much of it, about 20% a year, goes away in terms of what counts as regulatory capital. So it naturally makes banks have to make a decision. So now what they're doing is they're going back to the market today and refining the debt they issued 4 or 5 years ago. And that market, Charlie, is absolutely on fire. And the spreads have come in. We were issuing debt a few months back in the high 7s. We're now in the low 6s. So spreads have come in. There's a lot of interest in this paper and debt market. So that market, wide open. A lot of your listeners who issued in 2020 or 2021 will be coming back to the market for the most part to refinance and get the full benefit of the regulatory capital.
Okay. So now I got to ask a follow-up question.
Sure.
Because you lost me in there somewhere. Okay,
That's okay.
so
I'm good at
let me just
people.
give you
Yeah.
a use case. I want to raise, I'll make a very low number, $1 million. I want to raise $1 million, so I go issue subordinated debt. The million counts towards my capital, or it doesn't immediately? Or
Once you've raised it, you've secured it, right? You brought on that $1 million with a promise to pay 6% on an annual basis, right?
For the next 5 years or 10 years?
It's 10-year commitment, but after 5 years, it goes to a floating rate, and you have the right to call it and refinance it.
So at that period, I've got $1 million on the books, and now my balloon period comes up, or my float period comes up, right? At that point, I'm still at $1 million, but I have the ability to. What happens if I don't and I float it? Is the $1 million still $1 million, or is the $1 million a different number?
Your $1 million is still outstanding. The only problem is after 5 years, so you lose 20% of that counting as regulatory capital. So it stays on your balance sheet as debt. But now only 80%, or I can do that math, about $800,000 would count towards your regulatory capital in 2026. And then it would go down another 20% in 2027. And you're paying that floating rate, which at times, plus the original spread, can be pretty high.
Is that because over a 10-year amortization period, I paid some of it down? Is that why the number comes off, or what am I missing there?
No, it's a regulatory law, I guess, for lack of better terms, rule. It's a regulatory rule that after 5 years, you start losing regulatory treatment to the capital position. And so that's how these are structured.
But in general, what you're saying is if your floating rate is above that 6-7%, right? You were issuing at 7, now you're issuing at 6. It's time to take a look at that and say, maybe I can do better in the market.
And now you restart the clock on a new fixed 5 for 5, right? You're fixed for 5 years at 6%, and 100% of that's counting as regulatory capital for the next 5 years.
Gotcha. I mean, I guess what I would say is with a 5-year or 10-year amortization, why wouldn't the number change as you move along your payoff period?
Yep. No, thank you for the question. There's no amortization. So just to be very clear, that $1 million does not change unless you call it, right? So every year you have it outstanding, it's $1 million. You're paying your fixed rate for 5, and then after that, you pay the floating rate on the $1 million. From a regulatory perspective, so that $1 million does not change, but only as it counts in capital does it amortize away for the bank from a regulatory capital perspective.
Gotcha. No, but that's great. I mean, I think your point being that there's a transition point there where you say to yourself, somewhere between your regulatory capital discussion and the interest rate you're paying, you have to sit down and go, what's the market charging me to be up for that 5-year period? And what is, so really 2 or 3 moving parts there that you have to make decisions based on.
And Charlie, it goes all the way back full circle to the beginning of our conversation. It's all connected to the balance sheet needs. If you've got a lot of growth, right, you want as much regulatory capital as you can get. So you may want to go refi the market and talk about what you're going to do. If you let it float, you can let it float. That's not a problem. Lose a little bit of your regulatory capital, or you can just call it and retire the debt. You've got 3 options. And, every decision, and this is interesting, right? Every decision will be different for each bank, but every one of those decisions is a statement. It's either I'm going to continue to grow, I'm going to kind of hang where I am, or I don't need this regulatory capital. And so I think each of those tells their own story. And so that's why when you sit down in a strategic planning session, you really got to think realistically about the growth of the company, what types of capital are out there, what's the most effective, efficient way to raise capital. And sometimes, a lot of times, sub-debt can play a part of your overall capital stack.
Interesting. Super interesting. Okay. All right. So then just to wrap up one final thing here, you had mentioned there were sort of 3 capital markets, debt, equity, and then this between. Is the between just what we talked about, or is there more to the sort of between market?
There's the pure equity, there's the sub debt. Those are pretty easy to understand what those markets are. And by the way, both of those markets are wide open. I'd say that, and your listeners will know, preferred equity is different than common equity, and it does carry a rate, and there are some nuances to it. So it's kind of what I would call the in-between pure debt and pure equity. And so some institutions will go out and look at the preferred market. That market is much more usually reserved for the larger companies and not necessarily the community bank world that I spend my time in. But there are some preferred deals that get done. It bolsters capital differently and more effectively than sub-debt, but not quite as much as common equity. And so there's different rules and regulations on all of that. But all 3 phases of the capital markets are wide open. If you need capital for growth or an acquisition, all 3 phases of the capital market space is wide open.
Gotcha. Okay. So sort of the 3 legs of the stool, more or less.
Yeah. Yep.
Excellent.
Yeah.
Well, Scott, thank you. I appreciate you again. Always entertaining and always educational every time we have you on. So been very useful, and appreciate your time, and thank you for joining us again on BankTalk.
As I always say to you, thanks for all you're doing out there, and it's always great to catch up with you. So thanks again for having me, and we'll talk soon.
All right. Thanks, Scott. Take care.
You got it.
So that's all for BankTalk. Appreciate everybody listening in today. Have a good day and keep on learning.
Thank you for joining us on the BankTalk podcast, brought to you by Remedy Consulting. If you enjoyed today's conversation, please rate, review, and share our work with others. To stay up to date with future episodes, be sure to follow the show and turn on notifications. Thanks again, and we'll see you next time.